Part B of the question, I read, Filler Limited is considering to purchase a new machine so as to improve its production process, which is currently being undertaken manually. The second sentence, the machine costs 13,950,000. The firm will incur installation cost of 450,000 shillings. The machine will have an economic life of 6 years, but will require an overhaul at the end of the 4th year. The overhaul will cost 1,125,000. After 6 years, the machine could be disposed of for 900,000 shillings. The company estimates that it will cost 2.1 million per year to operate the new machine. The current manual production method costs 5,250,000 per year. In addition to reducing annual operating costs, the new machine will allow the company to increase production capacity by 120,000 units per annum. The company realizes a contribution margin of 45 shillings per unit. Additional information: number 1, the company applies straight line method of depreciation. Number 2, corporation tax rate is 30%. Number 3, Filler Limited requires 20% return on all investment. That should be on all investment and not an all investment. Required using NPV, project evaluation method. Advise Filler Limited on whether or not to purchase the machine. Now, questions on capital budgeting can be easy, but they can also be a bit tricky. Okay, and you cannot say you have mastered capital budgeting because the questions can be varied. Like this one has never been set this way before. The one you are going to sit may be totally different, even if you understand this one today. But it's important for you to get the concept. And I've always said, when you have such a question, step number 1, what are you supposed to do? The first thing to do. What should you do first? Step number 1. Yes, capital budgeting is not a joke. It is not a joke, Willis, because of the nature of the decisions that are made in capital budgeting. As a finance manager, you are required to help the company make such decision. It's not a joke because money that is invested in a capital project is quite substantial and significant, and therefore there is no joke when you are dealing with such kinds of money. In working capital management, you are dealing with the day-to-day expenditure. This question, okay? Working capital, we are referring to paying of day-to-day expenses. But in capital budgeting, a decision that is made in capital budgeting, if you make a mistake, then that can lead to corporate failure. That's why even questions in your exam are quite, but be that as it may, I'm saying, when you have such a question in the exam, you can see the question is 12 marks. These are many marks. You need to try and score at least 10 or at least 6 marks out of this question. As much as the question may look technical, you can still score some marks. Now, when you have a question like this one, just like the other one, the first thing to do is to put down the formula using NPV. What's the formula? NPV. Formula, net present value. Net present value, you are just comparing two things. The money that comes in and the money that goes out. Then you get the net. Okay? So, this one is constant. The formula is constant. Net present value. It doesn't matter the level of complexity of the question. The formula still remains the same. So, NPV is equal to the summation of present values of cash inflows, cash inflows minus the present value of cash outflow. In capital budgeting, is just the initial investment. Present value of initial investment. So that's what you do first. Is that clear? Formula. Then it is from this formula, then you can be guided on what to do. From this formula, we know we just need two things. Present value of cash inflows, and a question may have one inflow or multiple inflows. So you will have to aggregate all the inflows. Then you subtract the initial investment from the inflows to get the net. I think that is quite easy. Are we clear up to that point? Are we clear? That is clear. We just need two things. Then we get the net to get the answer. Anything else that we are going to do is just under workings. Any calculation we are going to do, those are workings. You understand? So, what are the cash inflows? What are the cash inflows? Once you have the formula, then you can proceed. We identify the cash inflows from this question. We read the question that Fila Limited is considering to purchase a new machine so as to improve its production process, which is currently being undertaken manually. That sentence, there is no inflow, is it? No. Second sentence says the machine costs 13,950,000. That is not an inflow. That is an outflow. Then we read the firm will incur installation costs of 450,000 shillings. That is an outflow. It's not an inflow. The next sentence I read, the machine will have an economic life of 6 years, but will require an overhaul at the end of the 4th year. Will require an overhaul, and the overhaul cost will be 1,125,000. That is an outflow. Then we read after 6 years, the machine could be disposed of for 900,000. Will be disposed. When you dispose a machine, is that an inflow or an outflow? Can you answer that question? When you dispose a machine, yes, that is an inflow. So the 900,000 shillings is an inflow. It will be part of this. That's why I put here summation. That is one of the items we need. So we have it, 900,000 shillings. In financial management, what is the name we give to these 900,000? What is the name? of this 900,000? Abraham says working capital. Is that true? Salvage value. Salvage value. Everyone is saying salvage value. Abraham says disposal value. What did the examiner call it? The machine could be disposed of 900,000. In technical terms, that is what is referred to as terminal cash flow. Terminal cash flow. So we are calculating cash inflows. So the first one is the terminal cash flow, which is the salvage value, as you are calling it, or scrap value, as you are calling it. But in technical terms, that is the terminal cash flow. Because in another question, this terminal cash flow may be used. You'll be told that the terminal cash flow is 900,000 shillings. Okay? So this is equal to 900,000. The next sentence reads that the company estimates that it will cost 2.1 million shillings per year to operate the new machine. It will cost 2.1 million shillings to operate the machine. The current manual production cost is 5.250 per annum. The current. In addition to reducing annual operating costs, the new machine will allow the company to increase production capacity by 120,000 units per annum. Okay? Will allow the company to increase production capacity by 120,000 shillings per annum. The company realizes a contribution margin of 45 shillings per annum. That is where we also have cash flows. Contribution is a cash inflow. Okay? Is a cash inflow. So, candidates, one cash inflow is the 900,000. Then the second paragraph gives us other inflows. Other inflows. The question reads that the current manual production method costs 5,250,000 per annum. In addition to reducing annual operating costs, underline that one. In addition to reducing the annual operating costs, the new machine will allow the company to increase production capacity by 120,000 units per annum. So, in addition to reducing annual operating costs. Now, that reduction in annual operating costs is an inflow. It is a saving. By acquiring this machine, the company is going to save. Okay, that saving is part of what we'll need or use to calculate the what Omiti says annual operating cash flow, because it is annual operating cash flow. Okay, I want you to note that cash inflows can be in form of savings. It can be in form of, look at the next part of the sentence, the new machine. In addition to that, then the new machine will allow the company to increase production capacity by 120. So those are two inflows. The saving and the 120 units, because the 120 units is additional, will increase by over and above what the old machine is capable of producing. This new machine will produce excess by 120,000 units per annum. And you are given the company, that the company realizes a contribution margin of 45. Because that is, if you understand that, candidate, then we can move. We can move. So we have the terminal cash flow. Then we have the saving. Then we have the contribution. This will give us the present value of cash flows. So it's important to get the understanding. Analyze the question. Put down the formula first, then check from the question, where do you get these inputs? So you've seen this will come from, first of all, the terminal cash flow. And by the way, terminal cash flow represents the net cash flow a project or investment is expected to generate at the end of its useful life. That's what we are referring to as terminal cash flow. What is expected to be raised from the project at the end. This is a machine that is bought now, then at the end of the 6 years, it will be sold. That salvage value, or what you are calling scrap value, is a terminal cash flow. So have you understood up to that point? Because it's important for you to first of all understand where are the cash flows coming from. Because the question ends at realizes a contribution margin of 45. That is all. We've finished analyzing the present value of, the cash flows. Can we proceed? So we can proceed to calculate the cash flows. The cash flows. Let me use the term that Omiti used, annual operating cash flow. The annual operating cash flow. Let's proceed. Let's proceed. Let's put ink to paper. Ink to paper. Workings. So we are first of all going to calculate the incremental net cash flows. Omitted said operating cash flows, but it's supposed to be incremental net cash flows, which will be equal to the incremental earnings before depreciation and tax, okay, times 1 minus t plus the incremental depreciation tax shield. Underline incremental. Okay? Incremental. Why incremental? Let's take it again. The question. The company estimates that it will cost 2.1 million per year to operate the new machine. Okay? The current manual production method costs 5.250 per annum. In addition to reducing annual operating costs, the new machine will allow the company to increase production capacity by 120 units per annum. Will allow the company to increase, okay, production capacity by 120 million. That is incremental. That there will be incremental cash flows. There will be incremental cash flows. I want you to note that the new machine will allow the company to increase production capacity by 120. Okay? So, we've seen that the cost of, let me put it down, the cost, we have the cost, the current cost, the current manual production cost method, okay? The current manual production cost, the current, let me use the words in the question, the current manual production cost is 5250. That is the current. Okay. Then we read that the company estimate that it will cost 2.1. It will cost 2.1 per annum to operate the new machine. So it's going to the new machine, to operate the new machine, it will cost 2.1 million. So what is the difference? This difference is an annual saving. You understand? Currently, before, it is 5.2. But if this company buys this new machine, it will go down. This cost will go down. So what is the difference? What is the difference? Vincent says 3150. 3150. That is the annual cost saving. 3150. 3150. Correct. 3150. Now, to this 3150, we are going to increase that to include that additional contribution. Additional contribution. Additional contribution, we've seen, will be 120 units. This is 120,000 units times the 45 shillings per unit. This is the contribution. We add it to that annual saving. 120,000 units times 45 shillings. How much? 5,400. 5,400. These are inflows. What is the total? Total. What will be the total? 8550. 8550. That 8550 is the annual benefit before tax. Annual benefit before tax, that one. That is the annual benefit before tax. Then what is the tax? Is it 30% of 85.50? That is the tax. Apply the tax. How much is the tax? The tax 25.65. 25.65 is the tax. Remove the tax. That will be the benefit after tax. How much is it? 59 annual after tax benefit. 59.85. This is the annual after tax benefit. That is the annual after tax benefit. Is that clear? So this is the annual after tax benefit. So I would like to understand this working among the three components of cash flows. Which working? The three components. We are calculating cash inflows. Abraham, we are calculating cash inflows. And we have seen that cash inflows are in two categories. One is the saving. This saving. If this new machine is bought, the cost of production will reduce by 3,150,000 annually. Okay. Another cash inflow is the contribution. This contribution. Because this is a new machine, this machine will produce 120,000 units more than what is being produced by the old machine. So the contribution is 45 shillings per unit. You multiply by the number of units to get this 5.4 million. Then the total annual benefit, which is equal to the saving in production costs and additional contribution. Because most questions candidates, you are always given just the contribution or the cash flows. But you need to understand this cash inflow can be in form of saving. It can be in form of saving. It's like these videos you bought, those of you bought videos at 4,500 shillings. If you are to go to a physical class, you would pay 10,000 shillings. So the difference is the saving. Okay, so it's like you've not spent the money, but you've saved. That saving, by making the decision to buy online videos, you saved money. Instead of paying 10, you are now paying 4. So the difference is a saving. So savings, when you are making the right decisions, you retain the money. So that is the money that you will retain. So that is it's like an inflow. Okay, so that is the total. Then we deduct the taxation. Then we have the annual after tax benefit. We remove the tax. And that is just one point. There is another technicality, candidates. This is not what we'll apply here. This is just a working because let me take you back to the first paragraph. The firm will incur that. Then the third sentence says the machine will have an economic life of 6 years, but it will incur an overhaul cost at the end of the 4th year. The overhaul will cost it will cost 1,125,000. After 6 years, then it will be disposed of. Okay, it will be disposed of. So look at the board. Look at the board. The incremental cash flows, we've seen that is equal to the incremental annual tax benefit, because this is the incremental annual tax benefit, this one here, after removing the tax. This is what we have obtained. So to calculate the incremental net cash flows, which we need to discount here, we need the incremental after tax benefit, which we have calculated, but we also need the incremental depreciation tax shield. The depreciation tax shield, okay? The depreciation tax shield. We need to add to this annual after tax benefit. We need to add, this is addition, we need to add the incremental depreciation tax shield. So this is just part of the working. We need to do the incremental depreciation tax shield. And you can see depreciation is in two parts. Depreciation in this question is in two parts. So to calculate the incremental depreciation tax shield, we need first of all to determine the depreciation. It is depreciation tax shield. And the candidates, to help you understand, depreciation tax shield is the tax savings that a company realizes from claiming depreciation as an expense on its tax return. Because by now you know that depreciation is a non-cash expense that represents the gradual reduction in the value of tangible assets. So when a company purchases a depreciable asset, it spreads the cost of the asset over its useful life as a depreciation expense, as we have seen in this question. We've been given the depreciation details on depreciation. So a company will spread the depreciation expense over its useful life. And the depreciation candidate's expense effectively reduces the company's tax. All right? Depreciation reduces the company's tax. Depreciation effectively reduces the company's tax liability by an amount equal to the depreciation expense multiplied by the tax rate. So depreciation tax shield is equal to the depreciation expense times the tax rate of 30%. So to calculate the depreciation tax shield, because we know the tax rate, we are required first of all to calculate the depreciation. Do you understand? That's the meaning of depreciation tax shield. And I know you are taxation students. You've covered taxation. Understand when I say that depreciation is a non-cash expense. Okay? It is a non-cash expense. Non-cash expense. So let's calculate depreciation, which we'll now use to determine the depreciation tax shield, which is a tax saving. Okay? Depreciation. I'm aware at this point I lose some of you, but to find way you have to get lost. Okay? Then you find your way. So you want to determine the depreciation. Question reads, The company is considering purchasing a new machine so as to improve its production process, which is currently being undertaken manually. The machine costs 13. This new machine will cost 13,950,000. The firm will incur installation cost of 450. The new machine will have an economic life of 6 years, all right, but will require an overhaul at the end of the 4th year. The overhaul will cost 1.125 million, okay, after 6 years, all right, after 6 years. So what is the depreciation? Annual depreciation. Now, if you are given the economic life, you are told that the machine, the the firm will incur installation, and then the machine will have an economic life of 6 years. So that means that this company is using the straight line method of calculating depreciation, which is equal to cost minus salvage value over economic life. That is a straight line method. Straight line method. Okay. So the machine will cost 13,950,000. The firm will incur installation costs. So the cost will be the purchase price plus the installation cost. So that will be 13,950,000 plus 450. That is the cost, okay, that we are going to depreciate. How much is it? 14.4. So this is 14.4 million minus the 900,000. We divide by 6. We divide by 6. That is the annual depreciation. This is 2250. Then look at the second last sentence of the first paragraph. We read that the machine will have an economic life of 6 years, but will require an overhaul at the end of the first year. The overhaul will cost 1.125 million. So candidates, that cost ought to be depreciated also. You understand? If you are doing financial reporting, what does that mean? This amount has to be capitalized, just the same way we capitalized the 450. The installation cost is a cost that was capitalized. Okay? This overhaul cost should also be capitalized. The overhaul cost has to be capitalized the same way we have capitalized the installation cost. And that is what we refer to as amortization. That cost, amortization. We need to amortize. Okay? So the amortization will be from which year to each year. We read that the machine will have an economic life of 6 years, but will require an overhaul or at the end of the 4th year. At the end of the 4th year, that means that the machine will be capitalized at the beginning of the 5th year, then the 6th year. So amortization cost is going to be 1,125,000 divided by 2. That will be the amortization cost per year. How much is it? How much is it? Yes, 2 years. So per year we divide by 2. Per year we divide by 2. 562.5. 562,500 per annum. Do you understand? The cost is first of all capitalized, then you depreciate it. Do you understand? Someone is asking, why not 4? There are 6 years. 1, 2, 3, 4, 5, 6. Someone is asking, why not 4? It's not 4 because the machine will have an economic life of 6 years, but will require an overhaul at the end of the 4th year. At the end of the 4th year is the beginning of the 5th year. So there are 2 years. This amortization will only apply for the 2 years. This cost will be incurred at the end of the 4th year. So that's why we are dividing by 2. 1, 2, 2 years. That is I'm answering DML's question. We are dividing by 2 because this cost was incurred at the end of the 4th year. This machine's economic life is 6 years. It worked very well in year 1. It worked very well in year 2. It works very well in year 3. It works very well in year 4 until the end of year 4. So they needed to boost this machine so that to overhaul it. Maybe there is a gadget that needed to be replaced. When you are running a machine, if you have a car, you know what I'm talking about. If you buy a new car today, you may not incur any expenses for 1 year, 2 years. Some cars is even 5 years without changing anything. But as the car is being used, the car depreciates some spares, or some, not spares, but some items, the shocks wear out, so they may need to be replaced. You overhaul it, okay? The wheels may need to be changed. So if you have a machine, that's what happened. And as I said, when you are looking at these questions, candidates have a practical mind, because this is a practical thing. Here we are talking about is practical application of is practical financial management techniques. The NPV is a practical technique. So here this machine has, when it was bought, it functioned very well year 1. Year 2 it functioned, it's meant to function very well. Year 3 to function very well. In year 4, this machine is getting tired. And the same thing even happens to you. When you are young, you run. As years go by, you find that the speed reduces. As you age, sometimes you are not able to walk. All right? There are people who bend even their back. There comes a time you cannot walk. Machines also, they have economic life. You see? Life. The life as the machine is being used. So at the end of the 4th year, the machine was, the company had to spend 1,125,000 to overhaul it. That means that the machine was in business just for 2 years, because at the end of year 4, it's the beginning of year 5. So it was depreciated in the 5th year and the 6th year, 2 years. You understand? And the same way we added 450, the installation cost, it was capitalized. Okay? And there is even a standard. If you are a financial reporting student, you should be able to tell me under which standard do we capitalize such costs. Okay? If you are an auditing student, as an auditor, you are also required to know that standard, so that when you are auditing the records of a company that has made such an expenditure, you need to check if this expenditure was capitalized. Okay? If it was capitalized. So I've answered the question on 2 years. Can I have another question? So that is, where were we? We are here. We are here. So why are we calculating depreciation? Why are we calculating depreciation? Let's get back. We digressed a bit. Why are we calculating depreciation? We are calculating depreciation so that we can apply the tax rate to get the incremental tax shield, which will now help us to add to the annual after-tax benefit to give us the incremental net cash flows, which will now get the present value, then deduct the initial investment to get the NPV, then we can advise the company. Because after understanding the depreciation part, this is part of a working. We've calculated the incremental after-tax benefit. We need to add the incremental depreciation tax shield, okay, which is a tax saving. Okay, we say that depreciation tax shield is a tax saving that a company realizes from claiming depreciation as an expense on its tax return. Is that clear? Is that clear? Someone said that one is tricky, which now is not tricky. Can we now proceed? So we need to calculate the depreciation tax shield. Depreciation tax shield. Depreciation tax shield. So from year 1 to year 4, depreciation tax shield will be different. From year 5 to year 6 per year. Okay? Depreciation tax shield, year 1 to year 4 will be the tax, because DTS, the tax saving, is equal to the tax rate times the depreciation, 2250. That is per year. Then year 5 to year 6, the depreciation is, tax shield will be 30% times 562,500. So can you give me the depreciation tax shield from year 1 to year 2? And this should be per annum. 2,250,000 per annum. What will be the DTS per annum? The DTS per annum. So we have depreciation tax shield year 1 to year 4. Then we have year 5 to year 6. Please pay attention. Pay attention. Or let me analyze. Let me find a way of simplifying it. Let me find a way of simplifying depreciation before the tax shield. This is still okay, but let me present this differently so that someone does not say depreciation is also, the depreciation tax shield is also tricky. So that you may not say it is tricky, let us analyze depreciation. Let us analyze depreciation before we get to the tax shield. So we have depreciation year 1 to year 4. Then we have depreciation, this amortization, year 5 to year 6. Depreciation is in 2 categories. Depreciation from year 1 to year 4. Okay, that is depreciation per annum. Per annum from year 1 to year 4 is 2250. Okay, per annum. This is depreciation per annum. The other category is year 5 to year 6. We still have 2250. All right. Then we have annual amortization. Annual amortization. There is no amortization between year 1 and year 4, but we have this amortization per annum of 562,500. So this will be the total. We have that total and we have that total. So this is 2250. Then give me this total. 2250 plus 562,500. To 2812. 2812. 28 12. 2812. Abraham says 2418. 28 12 500. 28 12 500. So this was yet another complication. Candidates, the depreciation per annum from year 1 to year 4, we calculated it here. This is the depreciation per annum. Year 1 to year 4 per annum, 2,250,000. Depreciation per annum for the 2 years is in 2 parts. This original machine, which has a salvage value at the end of 6 years, so this one is maintained at that. Then we add this amortized cost, the amortized cost. Okay, the cost that we amortize, 562,500. Overhaul cost is also capitalized and depreciated or amortized. It is amortized. So between year 5 and year 6, these 2 years, the annual depreciation is not 2,250,000, but 2,250,000 plus 562,500. Is that clear? Is that clear? So that the depreciation tax shield per annum, year 1 to year 4, will be 30% times 2250, and for the other 2 years, this is per annum. What we get here is per annum. For the 2 years, it will be 30% times 2812.5, again per annum. That is the DTS per annum. DTS per annum. How much? Yes, it is clear. Abraham says year 5 to 6, 873. The depreciation tax shield, year 1 to 4. This is 843. 843. 843. 843. Okay. How about year 1 to year 4? 843, 750. Per annum, year 1 to year 4. Year 1 to year 4. 675. 675. So this is 675. That is the depreciation tax shield. Why are we calculating the depreciation tax shield? So that we can add it to the incremental annual after tax benefit to get the incremental net cash flows. All right. So is that clear up to that point? So we need to add these two. Incremental cash flows. Incremental cash flows. So we have year 1 to year 4. Year 1 to year 4, the annual after tax benefit. Annual. This one. After tax benefit. From year 1 to year 4 is 59,85,000. The same here, 59,85,000. Okay, that is the annual per annum. Per annum. Then we add the DTS, incremental DTS. We add this annual incremental DTS, which you've calculated here. From year 1 to year 4 is this one, 675. We are adding candidates, this and that, to get the incremental net cash flows. So year 5 to year 6, the DTS is 843,750. So we're going to add these two. That will give us the incremental net cash flows. The incremental net cash flows. The incremental net cash flows. So the total, give me this total. The incremental net cash flows, year 1 to year 4. Incremental net cash flows, year 1 to year 4. Israel says 1,666. 666. Is it 666? 666. 66600. Yeah, 66. 0, 0, 0. Year 5 to year 6, what is the total incremental cash flow? 620, 68, 28, 68, 28, 68, 20, 68, 28, 750, 750. These are very important working. That is a very important working. So at this point, I need another paper. In an exam, you call for another booklet. Okay, if you're in an exam, see you have done everything. So you ask for another booklet so that you can continue. I don't need this. Yes, I don't need this. I don't need this. I don't need this. Another booklet. All these workings, candidates, was to help us get the cash flows. These are cash flows. These are the cash flows. And these cash flows are future values, which we now have to discount. We're now going to discount these values so that we get the present value, the summation of the present value of the cash inflows. And remember, we've not even done that again. After that, we'll calculate the initial. So do you understand how we are moving? We are now want to discount these cash flows. Because you see, these are values at the end of year 1, at the end of year 2, year 3. These are in future terms. So we need to discount. Then we deduct the initial investment to get the NPV. Then we will advise this company. Are we on the same page? We need to get the present values. Present values. We are now going to get the present values of the cash inflows. So begin with the year. We'll have a column for year. And you see we have year 1 to year 4 cash flows. Year 1 to year 4 cash flows. So we have year 1 to year 4 cash flows. Then we have year 5 to year 6 cash flows. Do you see the cash flows? Year 1 to year 4 cash flows. Year 5 to year 6 cash flows. They are different. The cash flows that will be received from year 1 to year 4 is different from the cash flow that will be received from year 5 to year 6. So we have to make it clear. Then we recall the terminal. There is also the terminal cash flow. The terminal cash flow, the 900,000. We also need to discount it. So these are cash flows. Year 1 to year 4, 666, 666. Year 5 to year 6, that is 6828, 6828, 750. Terminal cash flows, 900,000. Then we are going to have the present value annuity factor. Now, these cash flows are also in 2 categories. These are annuities because they are uniform throughout year 1 to year 4. It's the same. That's an annuity, an inflow. Every year from year 1 to year 4, the company will receive 6,650,000. It is an annuity. So we are going to discount this one. Let me have it here to help you understand. This first one is going to be the present value annuity factor. We know the discounting rate is 20% from the question. The last additional information, Filler Limited requires 20% return on all investment. So the discounting rate is 20%. 4 years. So we're going to multiply this one, the present value annuity factor, 20%, 4 years. What is the factor? Give me the factor. 2.5887. 2.5887. The other one is 6 years. Only change this to 6. Give me the factor. To get the present value annuity factor at this point, year 5 to year 6, the factor will be present value annuity factor 20%, 6 years, minus present value annuity factor 20%, 4 years. So we are going to calculate two factors. The difference is what we are going to have here. So if you got 3.3255, so it's going to be 3.3255 minus 22, 2.5887. That would be equal to 0 point something. 0.73. 0.7368. 0.7368. I know we'll lose a few people there. Those who did not attend our classes. You will have a question here. Why not 3.3255? You'll have questions. Let's move on. The factor for the terminal cash flow. Give me the one for 900. This one. Someone says 0.7368. If you got that one, this is wrong. If this is what you are getting, then that is not correct. Ask me why. This one is not correct. Yes, 0.3349. You saw your mistake. 0.3349. 0.3349. 0.3349. 0.3349. Then apply the factor to the cash flows. Give me the present values. Then give me that total. Present value 1 to year 4. Multiply that by that right there. That by that right here. Right by that right here. Get me the total. How did you get 0.3349? How did you get 0.3349? How did Emma get 0.3349? 0.3349, Emma, is not an annuity. It is not an annuity. It is a lump sum. This money will be received at the end of the economic life. It is a terminal cash flow. It is a terminal cash flow. And we say the terminal cash flow is the amount of money that the company expects to receive at the end of the life of the asset. So it is a lump sum. It is not an annuity. And the present value interest factors of annuities, the formula is different. This is the formula, 1 over 1 plus r raised to n. That is how you get 0.3349, where r is 20%, n is 6 years. Is that clear, Emma? Correct. Total 22,573. Someone is getting 22,573. 22,573. 575. 575. Third is 30, 14, 10. 30, 14, 10. Second, 50, 31. 50, 31. 50, 31. 423. 423. The first one, 17, 240. 17, 240. 17, 247. 742. That's the total. Make sure you get the figures right. Make sure you get the figures right. That is the figures right. Okay. So that is the total present value of cash flows. This is the total present value of cash inflows. All right. Then we deduct the initial cash outlay. Initial cash outlay. Initial cost. Initial investment. What is the initial investment? Look at the question. The machine costs 13,950. That is the purchase price is 13,950. We add the installation cost of 450. What is the total? Purchase price plus installation cost. Purchase price plus installation cost. 14,400. 14,400. To this 14,400, we add the present value of overhaul cost. We have to add the present value of the overhaul cost, which we saw will happen at the end of the 4th year. We are calculating the initial investment, which you have seen is equal to the cost of the machine plus installation cost plus the present value of overhaul. Present value of overhaul cost. The overall cost is 1125. So the present value will be 1125 times 1 over 1 plus r. Our r is 20%. It will be 1.2 raised to 4. So what is the present value? Kenneth says 542, 587, 5 542, 542, 587.5. 587.5. So what is the total? Purchase price plus installation cost plus the present value of overhaul cost will give us the initial investment. Again, it says 14,942. 14,942. 14,942. 14,942. 587. 14,982. 587. 587.5. Give me the net. What is the net present value? Mary says 76. Money 7630. 7630. 7630. 7630. 7630. 987. 987.5. That is a positive NPV. That is a positive NPV. Is everyone getting the same answer? 76. Israel is getting 7630. Yeah, 7630. 7630. So what is the advice? Because you are to advise using the NPV project evaluation method. Advise filler on whether or not to purchase the machine. Purchase or not purchase? Advice. Purchase the machine because the NPV is positive. Purchase the machine because the NPV is positive. NPV is positive. Formula. Advice. Okay. How many marks? 12 marks. So the reason why we've taken too long is because I'm taking time to help you understand. I'm also explaining terms, defining this. The terms that Abraham is talking about, I have defined all of them in this lesson. He's highlighted the incremental DTAs, the DTAs, the earnings before depreciation and tax, the terminal cash flows. All these factors I have explained, and it looks complex because you are doing it for the first time. Don't expect to just understand the question once and for all. No, you cannot just understand, or you cannot afford to just give up because it looks complex. You will recall there was a time you are not able to add 2 to 1. If you have a kid, just ask your kid 2 plus 1. The kid, today I asked one who was coming from school, another kid, I asked the kid, what is 1 plus 0? She told me 0, all right? There was a time you are also not able to answer such. So the reason why this one looks complicated is because you are doing it for the first time. And in the event that you get to the exam in the state you are in today, this is a question you avoid doing fast. You know, it's appearing as number 2. So this one, you need to run away from it. Do it as a last question. If you find it complicated, then you attempt, say, question 4, if you think it is easy. If you think there is any one that is easier, then you can attempt the ones that are easy so that you get time to come and it's true the question was not direct, because even the initial investment was not provided directly. It had some level of complication, and you've seen it here, because this one would earn you say half a mark. Do you understand? This can earn you half a mark, but it is also not direct. There was a working for it. Initial investment, purchase price, plus installation cost, plus the present value of overhaul cost. So the question was true indeed, not direct, but I've also helped you to how to approach such a question. First, put down the formula, then work downwards. Check from this formula what items can you, because you may not get this answer correct, but there are still, if you have correct workings, you can earn some marks. Okay, if you have done the correct amortization, there is half a mark for that. If you've done the depreciation, you get a mark for all that. So candidates, that is the end of the lesson. In this lesson, we've answered question 2, August 2023. In our next session, we are going to answer question 3, Financial Management, August 2023. Bye-bye.